When it comes to the infinite banking concept, you may be wondering, did you miss the boat? Are you officially too old to get started with this concept? That's exactly what we're going to talk about today. Hi, I'm Olivia Kirk.
I'm Tim Urich. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
When you think about life insurance, especially whole life insurance, you may be considering the cost of insurance. Quite frankly, as the insured gets older, so does the cost of insurance. So you may be wondering, is it too late? Is it too late to take advantage of this opportunity?
And the reality is, yes, the older you get, the cost per $1,000 of life insurance death benefit coverage definitely goes up. For example, I'm 62, Olivia is 33. So the cost for, let's say, $25,000 of life insurance death benefit is gonna be way more for me than it is for her. And there's a reason why. Think of it. Let's say we're looking at life paid up at age 100. That means the insurance company has a 38-year window to put money away for me so that the policy's paid up at my age 100. But for Olivia, they have a 67-year window, which is much longer. So the premium will be lower and the amount of money they reserve will be lower on an annual basis.
You see, with a whole life insurance policy, any off-the-shelf whole life policy, the insurance company is making you two promises. The first promise is to pay that death benefit out if and when the insured dies anywhere along the way, as long as that policy is in force. And the second promise is to have a cash value equal to the death benefit at the age of maturity. What that comes down to is at age 121, the death benefit and the cash value are going to be equal.
So think of it this way. There's a trade-off between the cost and the risk. The risk is that I will die sooner than her because I'm way older than her. So therefore, the cost is going to be greater. But the trade-off is that the insurance company is also putting more money away for me because they have a smaller window to fit in that money. Whereas for her, they have a longer window. They can let compounding work and they need to put less money aside each and every year.
Yeah, it's kind of like the compound interest curve, isn't it? It takes two factors for a compound interest curve, time and money. The longer amount of time you have, the more you could let it work for you, the less amount of money that you need to put in on a consistent basis. But when you have a shorter amount of time, in order to meet that same goal, you need to put more money away because you have less time to take advantage of that compound interest curve.
So now let's look at this purely from the infinite banking concept perspective, which is really the fact that you finance everything you buy. So the question, am I too old for infinite banking? I think it's relative because here's the question we always ask people. Are you done buying things? You see, you finance everything you buy. You're either going to borrow money and pay interest or you're going to pay cash and therefore give up interest. You're either going to pay up or give up. There's no way around it, except for the infinite banking concept. And the key to infinite banking is not so much that you'll recapture any interest, you may or may not. Ultimately, you will through the death benefit. But the key is you'll be in control of the process. And that's what we advocate for our clients, being in control of the financing function in their lives. And here's the key. Once you get to that point where you control the financing function, it is a much better life. It is a life that is, dare I say, stress-free.
Exactly. I'd argue that most of life's frustrations come from not having access to money if and when you really need something, right? If you're not able to put your hands on that money, man, does that make life challenging.
Yeah, and that's for either an emergency, a bill that comes up
An opportunity.
or an opportunity. And that's where it's most frustrating. You have a great opportunity to buy a piece of property. You know, a good friend of mine, he grew up in New York City, and he had mentioned to me years ago that his grandfather had an opportunity for like $45,000 to buy an entire city block in Upper Manhattan. And he couldn't do it because he didn't have access to money. And he was afraid of borrowing money. So ultimately, because they didn't have access, and my friend says, every time I drive or walk by that stretch of land, I think how much impact that could have had we owned that block in Upper Manhattan. And you see, that's the key. Infinite banking gives you access to capital when you need it most, so that you could finance through an entity that you own and control, which is your life insurance policy, and you're in control of the process, and that's the key.
A lot of times when we're talking to people about the infinite banking concept and how they could implement it in their lives, we won't necessarily talk about the death benefit, because when it comes to banking, the death benefit is kind of a bonus, right? So when we're talking about setting up a policy, we'll talk about the premium dollars. How much premium can you afford to put away? How much money can we find to put premium in the policy without impacting your cash flow? And we kind of back into the death benefit. And what the main difference is going to be is how much death benefit you could buy for your life versus Tim's life, for example.
But here's the key. The death benefit is the way you're guaranteed to recapture all of the interest that you would have paid over your lifetime, or the interest you would have given up if you paid cash over your lifetime, because the death benefit comes back to your family or your business on a tax-free basis. That is so hard to beat. And that's what makes infinite banking the strong concept that it is, and that's why you're never too old. Now, let me share this little tidbit with you. We have a client who was 83 years old when he started the infinite banking concept. He's now 91. He just built a slammer house. And I'm telling you, he borrowed against that policy like nobody's business. And that's the key. He is so thrilled that he's using that money, and then ultimately he'll leave a death benefit for his family. It is a win-win. He gets what he wants, which is the house, and his family gets the death benefit. Oh, and by the way, the house too. So it's a great, great tool for financing the things of life.
The next factor that's certainly going to come into play is insurability. Because as we become older, it's natural that we have more health issues, right, as the body ages. So there are factors that can make you uninsurable. Now, some people have a rating. That means the cost of insurance is higher for your age compared to other people. And in some cases, we're able to get you a policy if there is a rating. A policy designed for cash value accumulation. The main difference isn't going to be in the cash value accumulation, it's going to be in the amount of death benefit that we're able to get you for your age, for example. If you aren't insurable, let's say you've had cancer within the last 5 years, for example, or what else are we looking at?
Heart disease or some kind of, a stent put in or something.
Yeah, very recently. So a lot of them get better with time, the chance to get a policy. But it's going to vary on a case-by-case basis. So a lot of times what we'll do is we'll try to get insurance on you, see if you qualify. And if not, we'll look at someone who could be insurable, maybe your spouse or a child. Because as long as you have insurable interest in that person, meaning at the time of the application, you would suffer a loss financially if that person died, you could buy a policy on that person, assuming they agree to it. So there are ways to explore other options if, let's say, you're not insurable. But if you'd like to find out more about whether or not you specifically qualify for a policy, be sure to check out our website at tier1capital.com, and we'll be happy to chat that through with you on our free strategy session.
When it comes to implementing the infinite banking concept, again, it's relative. Nelson Nash was 51 years old when he discovered the infinite banking concept. And he was quick to say he discovered it. It was already there. He didn't create it. He just plugged into the system. And here's what happened. He was 51 years old. He was buried in debt from a business deal that sort of went bad when interest rates in the early 80s jumped to 21 and 22%. He was caught paying like $60,000 extra in interest that he wasn't prepared to pay. And at around the same time, he got his life insurance premium notice, and he noticed that for every dollar he was paying in premium, he'd get $2, $3, or $4 additional cash value increase. That's that cash value that Olivia and I spoke about earlier in this video. The cash value was increasing on this policy by 3-4 times. And he realized he needed to get his life insurance premiums equal to his mortgage so that in the future, if interest rates rose again, he'd be covered for any increases in mortgage payments. And that was the genesis of the infinite banking concept. So Nelson wasn't too old at 51. I'm not too old at 62. And our client wasn't too old at 83 because we are not done financing things in our lives.
If you enjoyed this video, be sure to check out these two. We picked them out special for you. Also, don't forget to give us a thumbs up and hit that subscribe button.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters. We'll see you in the next one.